Good morning, everybody, and welcome to the third in the series of webinars on earning the illiquidity premium. We've had two fascinating discussions on Monday and Tuesday, focused on real assets and private markets, and the risks and opportunities which each of those two types of investments gives rise to, the opportunities they create for investors and for portfolio managers. And today we're going to draw the threads together with Graeme, Bibby, and Rebecca Jacques from Partners Wealth and Mercer, respectively. I'll leave Adam to introduce them when we get going. But before I hand over to Adam, I'd like to just say a little about a couple of upcoming events for the rest of this year and early into the new year. Next week we'll be hosting a cocktail evening in Sydney with Dr. Tim Edwards, who's the global head of index research for S&P. He'll be talking to us about the insights which market data gives us at a time like this, and what a time this is. And he'll be talking about the way in which market data can provide insights into portfolio management. IMAP is hosting once again the Managed Account Zone at the FAAA. For those of you who will be in Brisbane and attending the FAAA, we'll be there in force. I think IMAP is the largest exhibitor this year with 10 leading managed account providers present at the Congress. So an opportunity for those of you who are there in person to approach our participants, talk about your managed account program and the options for establishing a managed account program. We'll run one more webinar this year on the 4th of December. Nathan Lim will moderate a panel with Chad Hitzman from GlobalX and Monik Katecha from InSync. We'll be talking about Asian markets, Asian opportunities, the opportunities that Asian investments give rise to in the context of overall portfolios. The award winners showcase in February will give us an opportunity to take the 2024 IMAP Managed Account Award winners and give them an opportunity to demonstrate their expertise as an introduction to the 2025 awards series. And finally, the Portfolio Management Conference in March. I needn't tell you how to ask a question, but we do encourage you to ask questions, and that's been a strength of both of the two sessions which we've had in this webinar series. Some really interesting questions that have grown out of the points that our presenters have made. So Adam, thanks very much for the work you've done this week, and I'll hand over to you to moderate today's session.
Thank you, Toby, and thanks to everyone for joining us. This is the third and final webinar in the series. As Toby mentioned, on Monday we took a deep dive into property and infrastructure, and we explored the current risks, the opportunities, and the broader investment considerations. And yesterday our focus was on private markets, where our panelists shared some practical advice and some best practices and key consideration, as well as tips for implementation. So today we'll wrap up with insights from two portfolio construction experts. Joining us, we have Graeme and Beckett. It would be great if you could switch on your cameras. Thank you. We have Rebecca Jacques, who is Mercer's Head of Investment Solutions for the Wealth Management client segment in the Pacific. She leads the Portfolio Solutions Group, which is responsible for Mercer's managed account business, the Advanced Diversified Multi-Manager Funds, and Mercer's Index Diversified Funds. With a financial services career spanning back to 1997, her focus since 2001 has been on constructing multi-asset and multi-manager portfolios. And Graeme Bibby is the CIO at Partners Wealth Group. He brings over 20 years of institutional investment management and consulting experience across various relevant sectors, plus an additional 7 years in multifamily office and wealth management in CRO roles. Graeme specializes in portfolio construction, investment team development, governance improvement, and expanding access to institutional alternative strategies. So I think you'll agree, very, very qualified panelists today. In today's discussion, we will focus on 3 key themes. Firstly, the reasons to include alternatives in portfolios. Secondly, separating realities from common misconceptions. And lastly, practical strategies for effectively integrating investments into client portfolios. I think it's going to be a really interesting session. So let's kick it off. Beck, first question for you. Real and illiquid assets have long been available to institutional investors. More recently, we've seen them included in the portfolios of larger clients who have personalized portfolios. But how accessible are they to the next tier? Let's call them the mass affluent.
Yeah, I mean, it's still it's a degree of challenges, right? And it's partly because of in essence, I guess what the heading of today was around about that illiquidity premium. But increasingly, you are finding what I call the democratization of assets that are coming down. And it's really enabled by a lot to do with technology. So we have started implementing them directly in our managed accounts book. But there's been a lot of structuring that's had to go on behind the scenes to try and match the liquidity profile to the actual portfolio and some of the underlying investments. So it's getting there, but it's definitely not 100% available to everybody. And to be fair, I think it's important to understand that they have differences in the way they behave and in terms of how the capital's called, how yields and income is paid out, which may be quite difficult for average investors to fully understand.
So better if it can be sort of managed in a controlled vehicle that does all of that for you.
Yeah, and look, the challenge is also understanding, I think, that we talk about looking at the underlying investments, but the terms and conditions play a major part in it as well, right? So understanding, exactly, I guess, I mean, many of us look at those offer documents and probably don't spend a lot of time reading them. You really do need to read them when you're dealing with sort of private markets, right? Because each of the investment can look the same, but there may be nuances that you're not picking up in terms of the terms and conditions, right? So yes, the best we still find that even very large investors still require a degree of specialization to understand the each of the variables that you're investing into. And Graeme, I'd probably hazard pretty similar to your world. It's still the investments piece is not necessarily easy, but it probably comes more naturally to people to understand some of the actual investments, but maybe the operations of those structures and the terms and conditions probably are what challenges them the most.
Yeah, I think there's in the institutional world, you've got big teams behind you. You're doing a whole lot of legal work, operational due diligence forming a big part of that. And for a mum and dad investor, be they mass affluent or into the wholesale investors, just them understanding what to expect, the capital calls, the offer documents. So we've got a job to do on behalf of those investors to do proper due diligence across legal, financial, operational due diligence, including investment due diligence, and to help them on the journey with education material and what to expect. And we've done a lot of work on that recently.
Right, thank you, Graeme. So from a diversification perspective, I think we probably all agree that it should take place at diversification should take place at multiple levels across a portfolio. So how would you think about diversification, firstly within that illiquid allocation, and then taking it to the next level, diversification that the illiquid components provide to the more liquid components of the portfolio?
Yeah, I'm starting off with that. I think you don't have to get too tied up into the buckets. You got to fill every bucket, because that gets very, very hard for advisors. If you have like broad exposure to factors, you've got real assets. What do you want? You want some sort of connection to inflation hedging. In other private markets, you want diversity of sectors and size. Companies that are staying private for longer, you're not able to get those in public markets quite as much. So it's a range of diversification, but you don't have to, as an advisor, necessarily construct that. You can look for different vehicles and ways that will do some of the blending for you.
Yeah, and one of the things, Adam, that we focus a lot on is making sure you're getting that sort of global diversification. It tends to get a little bit overlooked. I think Graeme's right that sometimes people think a lot about filling each of the little buckets. But within each of the little buckets, regions themselves have slight nuances and I guess degrees of speciality. So we do, when we look across real assets, whether it be property, infrastructure, and direct private markets of equity and debt, one of our biggest principles behind it is look globally, because it broadens that diversification suite. Now, that doesn't mean ignore what's local. It just means that they are part of that opportunity set, right? So don't just think of what you access here. And I mean, we see this a lot, even just on the listed sort of property side, when you look at how clearly one stock just dominates our market, right? So it's no different when you're playing in real assets, and we see that a lot, particularly like Australian debt is obviously very much skewed towards one type of sector and industry, versus the real opportunity set. And Graeme, you touched on it, right? It's around that whole opportunity set that's shrinking from public markets, right? So so you want to keep your opportunity set broad so that you can access different levers of industry sectors, factors, alpha return differentials as well.
Okay, so
Yeah.
Sorry, Graeme, I interrupted.
Yeah, example in public market bonds, you're only going to get very, very large companies who've got enough size to be able to issue in public markets. But there's a whole lot of middle market, smaller companies that you can access through private credit that you just can't access through public markets. So you can get a lot more diversification there, different drivers.
And Graeme, I don't know, sorry, Adam, I was just going to interject, but I don't know if you're seeing this, but we're also seeing that a lot of our clients want access to private markets, not just for, alpha, so to speak, but it's actually a lot about being able to get a wide range of investment opportunity set that just isn't now available in that sort of public market sense as it used to be, probably to some degree.
Yeah, and this probably comes from family office land where people will say, I want that company. It's private, but I want to have access to it, and they can actually get it. So you can get well before pre-IPO exposure for a mum and dad investor. You just can't, unless you can get into, there's some really interesting co-investment funds out there in PE and VC. So it just gives you broader diversity and things that you would never think that you've got access to, you can.
Right. So I guess I'll try and summarize those points to say there are opportunities to participate, but it's certainly not yet seamless. It is improving. And the second point is there are numerous advantages, significantly diversification, but once again, it's nuanced and needs to be understood.
Yeah, correct.
Rebecca, what are the misconceptions that you think investors most often have about private markets and illiquid assets in general?
So it's interesting because we always talk about private markets as being illiquid, but they're actually a constantly liquidating vehicle, which is interesting. So you have to be, I think you have to appreciate that, that maybe the liquidity is we're only focusing on one dimension, right? Which is liquidity of, can I withdraw my money, with, X number of hours or minutes notice, versus that they themselves are vehicles that are constantly sort of effectively drawing capital and releasing capital right back into the system. And I think that's where a lot of people seem to think that the reason we haven't accessed private markets is due to just that illiquidity, that we can't get them out. It's actually much more around the nuance of them being constantly liquidating that creates the challenges of reporting and dealing with them on an ongoing basis, because you're constantly having to ensure that you do have capital there to meet the demands that are coming through. And then still ensure that your portfolio is sufficiently broad enough and diversified enough, right? So you don't want to just, go into certain tranches and then you can't get into them again, or certain vehicles which might offer opportunity sets, but then you can never get access to those opportunity sets again. So I guess that's probably the biggest misconception that I see talked a lot about, in that they're locked up and you can't get hold of them. In actual fact, there's money flowing in and out all the time, right? But no, can you go and redeem your whole entire investment? Absolutely not, right? But that doesn't mean they're truly illiquid in I guess the pure sense of the word.
And that challenge with maintaining sort of a constant level of investment is often the reason why the IRR, the internal rate of return of the investment, differs from the return that the investor actually sees.
Absolutely, yeah. And look, we talk about, and I know, people talk about like the J curve, which is effectively that period of time where you've deployed capital to private markets and it actually hasn't been actually fully invested, right? So it sits in effectively cash or liquids until such time as they can, find the opportunity set. So matching that up so that you're not getting, I guess, that drawback down on portfolios is it's a pretty complex arena to navigate. And it gets even more complex when you go and slot it into a fully liquid portfolio.
Mm. Yeah, I think sort of talking about the illiquidity, there's, the underlying vehicle, as Rebecca said, in fixed income and private credit, corporate lending, typically is a lot shorter term. So you'll see this in things that might be in your portfolio already. So syndicated loans that are tradable. But when it gets to other private loans that are just between a borrower and a lender, bilateral loans, then they're often 3 years, but often they get refinanced in 2. So you've got this natural liquidity coming through. You've got an average maturity of maybe 1 year to 18 months in practice. So there's a great natural liquidity. Maybe they've got a lockup of 1 year to 18 months, which actually matches that liquidity, which is great. But in private equity or other funds, you might see a quarterly liquid with a gate of 5%. So be careful what you think the liquidity is. It might not be there when you want it, and they may gate you. But I think there's a good responsibility to ask the question of what's actually underneath. Is there a liquidity mismatch or not? That's on the one side. Another aspect, another misconception is that we've got these sort of semi-liquid funds, so I don't need closed-end funds. I think that's a mistake. For some clients, it has a role because, as Rebecca said, you've got cash drag and you've got other factors. So if you're big enough, you can build a program as a ultra high net worth, where you can layer into a number of things with primary and secondary funds and co-investments. You can have a fantastic program and you won't have cash drag because you're managing that off to the side and putting it in things that aren't just straight cash return.
Now, before we go on to further questions, we've got a question from one of the attendees, and I think it's important that they understand this before we move on. Can someone briefly describe what alpha means?
Yeah, I'm happy to. Or do you want to, Graeme? I mean,
take the Mercer approach. I've ex-Mercer, so I know the let's demystify that one.
Yeah, look, alpha is really what we talk about. So beta is, I mean, we use these words interchangeably, beta versus alpha, right? And beta is effectively what we're talking about is a market return where you're not required, in essence, there's no skill sort of required, right? Whereas alpha is meant to signify that you've outperformed a market or a broad opportunity set that can be replicated very quickly and easily through index, and that there is skill involved, and that skill could be multiple different parameters. It doesn't always have to be, you can individually, pick a stock. It can be quantitative methods. It can be all sorts of things that are used to generate a return over and above what can be just generated by investing passively in a market. Now, I tend to always get a little bit sort of, people always talk about beta as though it's a passive decision. In reality, that itself is also an active decision. But anyway, but that's the pure strict definition of it, of alpha versus beta.
Right. And that question actually leads quite well into another topic that is quite important for investors, and that is around benchmarks. So, Graeme, how should private market assets and illiquid alternatives in general, how should we be thinking about benchmarks?
Yeah, I think you've always got to ask the product provider or fund manager, what is your benchmark and what's the basis for that? So it should represent, it might not be fully investable. So in private markets, there are things like, Cambridge has a whole lot of private equity indices, which are really just medians of manager returns. You have that in property as well with the MSCI index for property, and that's just on funds. You can have that in private debt as well. So there's some long established indexes there. So you want to have a fair representation of what could I get if I was the market. So in other words, pretty much the median return. So that's really what it is, and that they are available. But often managers will have a performance benchmark above a fixed hurdle and a performance or carry of 20% above it, and say an 8%. That's pretty standard in private equity, and typically those base fees will also be 2% as well. So I think you've got to look at what is the market where they play, and be careful of that they're using a benchmark that doesn't represent their strategy.
Makes sense. And obviously benchmarks, as you alluded to, play sort of very, very much into the fee conversation as well. These assets are typically expensive to access, both from a fee perspective, and also transaction costs are often very high. If you think about the cost of buying and selling a building or a power plant or something like that. So Beck, maybe you can talk through how you think about the cost benefit analysis.
Yeah, I mean, we always look at things from a sort of, I mean, I guess this comes back to this alpha potential, right? So, I mean, you have to be mindful that in private markets, it's very difficult to, in fact, nigh on impossible in some arenas to actually invest sort of passively, right? But there are broad-based measures that you can look at, and most will use, to Graeme's point, a minimum return, right? So it's like there's a minimum hurdle that has to be achieved, whether it's cash plus or CPI plus something, because ultimately you've got to benchmark yourself to something that is tangible, as well as understanding what is the potential opportunity set, and are they actually delivering returns, or are they sort of, is it more effectively a bit of luck, right? So we focus a lot on what's, I guess, after fees, right? So, I mean, we do stipulate when we look at, like if we're, say, talking about private equity, what is that when we, what can we expect to earn, or what would we generally expect to earn? And as a general rule, if you're, investing in a broad private equity sort of pool, you want to be earning between 3 to 5% excess of what you could earn in a public equity sense, right? Over a reasonable time frame. But that's where you would expect, that, I guess, the opportunity set, the illiquidity premium, all of those variables to converge. So we do look at it relative, to a benchmark, and then we also look at it to the opportunity set. And ultimately, we care about what's the outright return after fees. Graeme raises a very good point. These markets tend to be relatively expensive. And it's partly the nature of the types of investments, but it's also the nature of, I think, the way the terms and structures of them and operationally how they operate. So fees to us are relevant in that they should be aligned to investors' interests, right? But what we care about is after fees, right? Because if I have to pay a fair degree of fees, but I'm getting a really good return profile, and it's aligned to the investor's interests, i.e. they're not, earning fees at the expense of, or, against what's the investor's interest. What I care about is the net return at the end. So we do spend and look, Australia as a general rule as a market is very fee conscious. So the interesting thing is that the globals, which in private markets, obviously, being global, has assisted quite a lot. But these guys are really noticing the fee pressures that they're facing when they come into our market, because of that very, very, clear focus on it.
Yeah, I think it should be a fair fee for the strategy and what they're employing, fair fee for their life cycle, fair fee for where they sit in the spectrum of dispersion of returns, and be very sort of risk conscious in that. So we think that you might not get a sense of what is relevant, what is not. So if you've got an advisor, I know Mercer did fee benchmarking surveys a while back, and that probably extends into private markets, and the research there, you'd have a very good idea of that, and so do we. So I think, talk to your advisor or consultant and get a sense of that, and they should know where things sit on the spectrum, because it is about net returns. We're about those getting the better returns in private markets, which, because of the persistence of that performance dispersion, you really do want to chase those high returning managers, but they can be hard to access, and they won't give fee discounts unless you're really, really big.
Yeah, and many of them have limited capacity, and you don't necessarily want to be allocating to the manager that offers the biggest discounts, do you?
Absolutely not.
Yeah. So Graeme, looking at the current opportunity set, do you think that opportunities are better in private markets? Here I'm thinking private equity, private credit, or do you think that this resurgent interest in real assets is presenting a great opportunity at the moment?
Yeah, I think it comes down to what's actually available in terms of underlying assets. We've seen a huge growth in both private equity, venture capital firms in market over the last 10 years, and particularly last 20 years. You look at Australia having grown from almost very, very niche venture capital and private equity to there's probably about 200 family offices and individual funds out there. You can go find out. Just search for venture capital limited partnership on business.gov.au, or early stage venture capital limited partnership, and you have a huge list. But then how to make head or tail of it? We use databases to do outbound research to map every single asset class, and there's a huge choice. You can start with a screening quantitatively of that, but there's also the experience of being able to have a look at opportunities and screening those. So huge amount. There's absolutely no shortage. I would get 1,000 emails a year at least now directly that are unsolicited. So there's no shortage of opportunities. It's just decoding what is what. And I think for the advisor, they're being inundated with the flavor of the month private credit fund. Here's a new VC fund. there's so much out there, and it's becoming more and more available. And there's the semi-liquid funds will probably double in the next 12 months, so there'll be even more choice.
Beck, do you want to add anything to that?
Yeah. I mean, look, private credit is going through quite a resurgence, or, sort of, to Graham's point, it's sort of the flavor of the month. But it really does come back to, I think, the opportunity set, right? And because if you look at why is private credit sort of really growing through the growth that it is, it has a lot to do with structural changes in the market, right? And in essence, what we're dealing with is that withdrawal of traditional bank financing, to certain sectors, right? And that's just been a natural occurrence that's been occurring, globally and domestically over a number of years. And what's interesting about it is, you do have to appreciate, I think, the spectrum of investments that are out there, right? Because, it ranges from, obviously direct lending in investment grade, which could be levered or unlevered, all the way up to, opportunistic, which is, distressed debt, credit dislocation, all those sorts of things. But there's a whole spectrum in the middle of what we sort of focus on, which is like that structured credit and specialty finance. And I think where people miss the point a little bit sometimes is that opportunity set was previously serviced by traditional bank loans, right? And as they've withdrawn from that, you get more private operators in that market space. So the type of loans themselves are not necessarily, riskier. Depending on where you are in the spectrum. What is riskier to a certain extent is the terms and conditions that may or may not have been negotiated appropriately. And I think it sort of takes us back full circle to what, we were talking about right at the start, that some of the underlying investment pieces we've already been exposed to and been in portfolios, just not in the types of structures that they're in today. And that is the challenge where, to Graham's point, when you're dealing with, large institutions, they have teams of lawyers that can look at these sorts of things. So I think you do need to separate sort of some of the structural trends that are driving what's going on, as to why we're seeing more and more of them, as well as, I think, people probably underappreciate the opportunity set that is literally shrinking in public markets, right? And you can track that, even just in equity space, as to the number of sort of investment opportunities that now are available to you across what range of sectors, and it's constantly shrinking, right? So your opportunity set naturally pushes you out more into the private market arena. But whilst the investment piece may be relatively familiar, it tends to be the terms and conditions that you need to spend a lot more attention on.
Yeah, and I think that access, as you're saying, Rebecca, is changing. So, a nice personal anecdote is that I used to own Sydney Airport, owned it for, it was Macquarie Airports originally, owned it for 15 years, 4x on the original investment plus distributions. And I got called by the share registry saying, "Are you voting for the for it to be taken over?" I said, "No way. I really dislike this being taken away from me." So a lot of these things are going public to private. You're seeing that trend, and that's continuing. But now through an access vehicle, and we've created this internally, I can access Melbourne Airport. So yes, you have the fees of accessing that through a vehicle, $10 million minimum ticket, breaking it down to 100K, but now I can access that. So that's what's happening. You're getting these alternate access vehicles, different ways to access that. And it started through family office. It also had the experience of doing that, creating a feeder at Mutual Trust as well for our high net worth clients, ultra high net worth clients. So the vehicles are changing. You're going from public to private. But you've got choice, but you have to go hunting for it now. You're not getting as much in public markets.
And Graham, it's a good point, right? Because, we talk about real assets and, infrastructure and property and
Yeah.
debt versus private equity. But, the privatization of real assets has been going on for multi-decades, right? Like, and that is a perfect example of where, a sort of what you would maybe have called, an infrastructure or, sort of space. And now, it's a private markets vehicle. Right.
Yeah, and I think it's really, for advisors, it's just bringing it back to, well, tell me what's underneath it. You and I, we've, very embedded in the institutional world. We know that world well. We know the terminology, but we've just got to demystify it. And I think, telling a story of what it is, so something that people can understand, make it similar to, well, it's like buying a house. There's fees to buy a house. If you want to get better returns, you probably have to renovate that house. Or reposition, redevelop it. So some common threads you can articulate across all of the different private asset classes, and there's nuances to that which you can just make real. So you're lending to a company, or you're lending to a property developer who's building an apartment building or land, and that's got to work. And I think the other point, just quickly on the role of banks, is that there's commentary in the media about private debt is inherently unstable. It's all going to blow up. I totally disagree. People who say that I know very well, and their friends, but we agree to disagree. And you look at banks; they are inherently levered. So they're less levered now than pre-GFC. But if they lose 10% on their loan portfolio, their equity is wiped out, because their equity is, it's just a bit over 10%. Private credit is not levered in Australia. It is moderately levered at the fund level offshore. So I think that's a key difference. Of it's actually, because of regulation, it's pushing it there. It's new, so there will be bumps. There will be, experience of some, early operators who aren't as able to work out problems. You will have that, but select well, and use your consultant or advisor with a good research team to be able to do that for you, and you can avoid that. And it's not an inherently stable thing. And be conscious of the market cycle. There'll be times when it will be better to get access to some pockets of different private markets.
And I think,
Graham, it's a good point, right? Because one of the things, I mean, we spend, probably similar to you, we spend a lot of time looking at the various providers, right, and access points. But one of the key areas that we also focus on is that ability to recover the debt if something goes wrong, right? Because to the point that, one, we go through markets, well, all of these investments go through market cycles, right? So we have to be conscious of that. But you also want to know how good are they at basically getting their money back if something goes wrong, right? So don't just go and source me an investment and say it's the latest, greatest thing. But what happens if it's not the latest, greatest thing, or something, starts, inherently going bad for them? So, you've got to look through the whole spectrum of it, and, make sure that you've got those sort of skill sets that are there and have been proven as well. Yeah.
Other practical experience, I had a role where I took over a portfolio and it had a defaulted Lehman bond in it. So I had to work it out. They didn't actually register that for claim in bankruptcy court, and we're asked to write it off. And no, we will look for an opportunity to register it later. So this ability to work out, you need experience through the cycles. It helps if you've, the credit, private equity, or you've had some experience in real transactions as well. So all of those things give you a sense of, is the underlying strategy and people and team and track record solid?
Yeah, absolutely.
And Graeme, I just want to come back to a point that you made earlier about the extent to which banks are levered and the private credit funds are significantly less levered. And a lot of people ask questions about the competition in the space. Is it driving down yields? Is it are the lenders accepting sort of reduced terms, but the reality is that because the banks are so levered, there is so much capital available to satisfy these loans now that are being met by private capital instead of bank lenders. So with that in mind, there is a question here about the persistency of the illiquidity premium, whether it has eroded. I think the question is on all sectors, but as more participants have entered the market.
Yeah, I think there's pockets of that. So if you just talk about broad market, just follow the median and pick a manager, then yeah, it will decrease, because I think some in the cycles of that. So we're seeing that at the high end of private credit right now. Just on a call earlier today with a property fund, and the ability of them to get competitive loans from non-banks has increased, still at a higher rate than big four banks. But it's, the spread that's being offered for those loans is lower. So we just don't play there. We look for areas where there are inefficiencies, and I think this goes to active management, is that you go and utilize active management where there are inefficiencies and they persist. There will be cycles, and we think that the current state, yes, there'll be some reversion, but not too bad. It's still going to look decent relative to public markets. It'll ebb and flow, but then you've got to pick the areas where actually there's performance persistence, because there's less competition in that particular area of private credit or private equity. We like middle market, we like lower middle market. You can get better terms and conditions. Whereas if you're competing against banks to finance a big leverage buyout, the returns aren't going to be as good.
Makes sense. Rebecca, how important is manager selection?
For us, it's basically the main game, right? So, manager selection, it goes to the whole point that if you roll up all the things that we've been talking about today, right, the terms and conditions that you come into, the cycles that investments go through, what experience that they have in sourcing and dealing with those investment opportunities in their market sort of space, and then also their ability to recover things as things go wrong. So for us, it's critical, and you need to make sure that which is one of the reasons I guess we talk a lot about. We see the opportunity as global, because you actually want specialists in certain arenas. Because they come with deep knowledge and experience and access points. But that makes it difficult, right? Because you need to be able to recognize that you've got to get a whole program in place, and you need to still keep that diversification. So for us, absolutely critical. That's what we spend, probably 80% of our time sort of doing is trying to find the right managers in the right spaces, in the right pockets at the right times.
Yeah, to add to that, it's particularly important in private markets because the dispersion is high, and the stickiness of that dispersion. Top quartile managers tend to stay top quartile. There's great research on that. Whereas top to bottom quartile in public market equities or bonds, the dispersion is narrow, and you can be top bottom. So it jumps around a lot, whereas there's persistence. So finding that manager is critical, but also getting access. So you want to be big enough so that you've got a group buying arrangement, or you're able to aggregate interest, and that's what obviously Mercer do and we do.
And that actually is answering a question we had here about, do the larger providers have natural advantages in terms of getting access to the best managers?
Yeah, some, but I would say also there's a middle market effect. So we don't want to go too big. We like middle market. Google that, see what it is. But it's in the economy and it's in assets. So mid-cap ASX stocks outperform both large cap and small cap over most periods in the last decade or a bit more. So why? Because small companies are still, they have a lot of competition. Mid-sized companies, once they start to get a competitive edge and they grow, and a lot of private equity and venture capital backing those companies. And then they get to a certain stage and they peter out. So the growth potential of a BHP, it's pretty hard to double unless the commodity price doubles. But if you've got a high addressable market, you can grow at 30% revenue every year and then get more operational leverage. Your profit grows. So that's another factor as well. And you can get that in private markets.
And Graeme, earlier on, you were talking about alternative points of access. We have another listener question here who is asking about illiquid options being offered through the ASX. Maybe some comments I appreciate from both of you on that.
Yeah, I'll kick off with that. So, well, it can be a useful way to get access if you don't have any other way to do it. If you're a retail investor, you can do that, and hopefully the ones that you select of the listed investment companies or trusts can do that. But they will have volatility with, the market sells off and they get sold off as well. So we look to, some will have persistent discounts, but then some will allow some, they'll be able to purchase back and have a illiquid version of that. So they can actually arbitrage between the two and maintain it closer to net asset value. So that's one access point. And then there's other access points through feeder funds and other structures to be able to do that. And locally, Australian unit trusts, but if you're big enough, then you go offshore to Cayman, Luxembourg, Dublin funds, then those family offices can go direct.
Yeah, and I tend to agree with it, Graeme. I mean, what you do is you look for, we particularly, will look for if there's listed vehicles, that there is a mechanism to try and, bring the spread between the NAV, back, right? Because you really don't want an opportunity for market participants to consistently see it trading at a discount, right? So, but the one thing I would add to it is, it's a great access point, and it's a great way to get access to a vehicle, which gives you the perception of liquidity. But this is this whole concept of you may not actually be able to, don't go into it going, oh, I've got a listed vehicle, so therefore I'm in an illiquid asset that's now suddenly liquid, right? It's not. So people need to be mindful of that. That it's giving you an access point, and to Graeme's point, because either your dollar size or the way you're trying to access it may suit you better, but it is not removing inherently the characteristics of the underlying investments.
Opportunities for liquidity with investments that remain illiquid.
Yeah.
Fantastic, thank you. So moving on now. Perhaps, Graeme, what are the primary considerations that you sort of take into account when deciding to include private or real assets into a client's portfolio?
Yeah, I guess we talk to the advisor and say what's the profile of the investor, their risk tolerance, their immediate liquidity and following liquidity needs. They may have major capital needs. They may have potential changes in life circumstances, because there's this idea that you just sort of go into, de-risk when you retire. But actually, what if you keep on living for a long time and you need money for more expensive, aged care down the track? So you actually need to keep some purchasing power there. So I think you'd look at those sort of things, and then just the education part of it. Some will be considered with estate consideration. So if they are an older family or individual, then they may not want to have things that are illiquid, but some may want that because they've got excess capital they want to pass on to the next generation, set up a foundation, or make sure that the kids and grandkids have some capital that will grow with them. So it really does depend on the situation, and age by itself is not the thing. It's really the whole situation.
Yeah, I mean, Adam, from our perspective, we always start right with the client objectives. I mean, ultimately, and you can bucket clients to a certain extent. You can bucket, broadly what's their risk profile. But the nuances around, to Graeme's point around like access to capital, future state, how long you're going to live, the longevity issue that sort of kicks in, all of those need to be looked at. I mean, more broadly, what I would add is that as structurally we're seeing, I guess, the opportunity set in public markets decline, and the overall sort of theme, I guess, that we're in currently, which is seeing that sort of convergence of correlations more frequently between bonds and equities, right? Doesn't mean that they're always going to do the same thing. It's just that sort of, I guess, tailwind that we were operating in for sort of circa about 20 years has probably sort of turned a corner, right? So that naturally leads us to, spending time, and to Graeme's point, there's a lot of education, right? Ongoing. You probably need these things in your portfolio, but here are some of the risks that come with them. And some of those risks are nothing more than making sure you've got the right DD done on, and the due diligence done on it, right? Because if you're aware of them and you can spot them and you're working with the right providers, those risks that can be largely mitigated, but you need to be aware of them, right? So that's sort of, I guess, the point that I would make is that, structurally markets are pushing people more and more into these arenas, because you need to get them in for, the issues around longevity, the issues around being able to generate sufficient enough returns. Whether you want to leave a legacy or not, you typically find that these things are making their way into portfolios.
And I guess having made the decision to include it, sizing then becomes the next major factor to consider.
Yeah, and sizing is based on a couple of things, right? It's based on, I think people need to be conscious of the fees, right? Because it does bring an element of fees to the table that need to be factored in. But then you also need sufficient enough diversification, because if you're bringing it in and it's just one slither of the market, then maybe that may be suitable, right? It doesn't preclude it, but you need to be aware that you're only exposed to one section or one structuring of the market, and that may ebb and flow in terms of how well it's going to behave in your portfolio. So there's a number of considerations I think you need to factor in when you're actually looking at the total size of it. And at the same time, you've got to make an allocation that's meaningful. Otherwise, there begs the question of, why bother to a certain extent?
Makes
a little bit to add to that is, another factor is the tax situation of the client, also the entities that they have available, whether it's SMSF, own name company, they may have a foundation. At a personal tax structuring, there's a lot of value to be added with that, and just the tax on the offshore distributions as well. And then there's product-oriented tax considerations. In venture capital in Australia, you've got early stage venture capital limited partnerships, which just give you really, really good, like almost no tax on those investments. So, but you have to be locked up for 10 years to get them, and those funds have to continue to qualify. So there's product level and there's individual level tax, which can make a huge difference in the selection and portfolio construction.
But I think tax is a webinar all on its own. So rather than go down that minefield, how should advisors explain the risks and opportunities of liquidity to their clients? Because I think that's a major consideration in the back of their minds when recommending these products.
Yeah, look, I mean, Graeme, you probably got a view on it. The way we think about it is it's really, I think it's about understanding the nature of the investments. And I do believe, to your point earlier, Graeme, it's about talking about what's actually underneath the hood. So it's all very well to generalize at times, and that does serve a purpose. But I do think, if you're an advisor talking to a client about it, once they understand the actual investment or the, you know, what they're investing in, a lot of it starts to make sense, right? Because it gets, you know, it gets very difficult to suddenly liquidate, you know, a massive infrastructure sort of, you know, if you're financing its debt as it progresses, they start to understand that very clearly, right? So I mean, that's what I would say. You know, I think you need to spend less time on the jargon that we're all embedded in, and focus really on what some of the investments underneath the hood.
Yeah, and a simple version of that is that old university research test, the marshmallow test. So it's delayed gratification. So if you want 2 marshmallows, you're going to have to wait. You're going to have to lock it up. If you want it right now, well, you can have the sugar hit of yeah, I can sell it now. But I think also within private markets, you do see you're getting the income from private credit. That's great, but that's not necessarily going to preserve your purchasing power. So you do need some growth, and you do need patience for the growth. So I think that's another way of framing it. It's illiquidity, patience, get your returns, and it's it's a less efficient market as well.
Look, we only have 5 minutes left. This has been a fascinating conversation. I could happily keep asking questions, but it might be more valuable to summarize what I think are the 3 key points from today's conversation. So in 2 minutes or less, Graeme, could you maybe sort of summarize the main reasons to include alternatives in a portfolio? Maybe if you've got any time, relate that to the macroeconomic environment as well.
Yeah, on the wires that you can get better returns for lower risk, and you've got to look beyond the the mark-to-market risk of just some things don't get marked. So what's the real risk? So the return to risk is pretty good. It's inefficient. So you can access strategies that consistently outperform the median. There's lots of things. There's a lot of misconceptions. I think you've got to dig behind those things, like is the liquidity really there? Have some patience for some things, and invest in some lock-up funds like those early stage venture capital limited partnerships. They're awesome. And then how every client's different. Access in different ways depending on client size, and have a blend. You don't have to go all in. I think it is about diversification. You can have public markets for your liquidity, but there'll be ups and downs. But then you've got to explain what's going on and what can be a complex strategy, and just relate it back to the what's actually under the hood. A real company, a real loan, a real asset.
Yeah, and the only thing, Adam, I'd add to it, right, is the one of the key things that we're seeing increasingly about people's desire to be in private markets is being able to access just different drivers, right? I mean, Graeme, you touched on it a little bit on before of that sort of middle market in general, whether it be public or private, their dispersion or ability to create return upside is significant. But also you typically find that these sorts of businesses or opportunities are in pretty innovative sort of spaces or industries that are evolving and taking shape. We also sort of see I guess that sort of focus where sometimes we've got investors that really want to be involved, where communities actually really want both private capital access to local businesses, right? So again, your opportunity set broadens. Now, be aware that that increases the risks, but I would just say, yes, there's the pure sort of what we talked about earlier, alpha and that ability and the dispersion of what's happening in public markets, but it's also that innovation, right? And it's getting access to, both innovative and developing sort of industries, ideas, and all the rest of it that come with it.
Thank you both. This conversation has been fantastic. There's been real depth of insights, real substance shared. So on behalf of all attendees, I say thank you very much, and I'll hand over to Toby to close it out.
And I just want to reiterate that it's a pleasure for me to have people with the experience that Rebecca, you and Graeme, you bring to this role of developing portfolios that incorporate assets that aren't necessarily well understood. Adam, thank you for the splendid job you've done over the last 3 days as moderator for the sessions on real assets, private markets, and then the session on portfolio construction. Thank you. It's been a pleasure to work with you. So just let me remind you, those of you who've joined us coming up from IMAP over the next a couple of weeks, an opportunity to join with us if you're in Sydney on the 26th for canapes and cocktails, and to listen to Dr. Tim Edwards from S&P. I know Tim is an absolutely excellent speaker. He's a delight to listen to, very entertaining. If you're interested, just drop us a note. If you're going to the Congress in Brisbane, we look forward to seeing you. And then our final webinar for the year on a different aspect of investing on Asian opportunities. So thank you all for joining us, and we look forward to you having a relaxing rest of the year as we run into Christmas. Thanks very much for your time.
Thank you.
Thank you.
Cheers, everyone.